All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
Myth versus reality. Ever wonder what history teaches us about investing? What is myth and what is reality? Well, stay tuned to find out. Welcome to another episode of 5 Minutes with Karim. Today is Thursday, May 22nd, 2025, and I'm glad you've joined me. Today, we are going to talk about some of the common myths and the reality, what history shows us. Let's look at the 5 of the most common myths about investing and the reality behind each one. Myth number 1, move to cash if you're expecting a correction. Reality, trying to time the market means you must get 2 decisions exactly right. 1 is when to sell, and 2 is when to buy back in. That's extremely difficult, even for someone like my hero, Warren Buffett. What you should do is to review your asset mix to ensure it is still aligned with your long-term goals. Here's what history teaches us. Since 1971, that's over 50 years on the TSX, declines of 5% happened almost every year. Declines of 10% happened almost 6 out of every 10 years. Decline of 15% happened 4 of every 10 years. And decline of 40% or more happened once in the last 50 years. Despite these dips, market tends to recover. In fact, the average return in years that experience a 10% correction is still positive. So, if your time horizon allows for patience, stay invested. Volatility is the price we pay for long-term gains. Myth number 2, stock market is like gambling. Reality, yes, daily movements can feel random. However, there are 2 major differences. Difference number 1, gambling is a zero-sum game. For someone to win, someone else must lose. Investing is driven by real business growing profits. Everyone can win over time. Difference number 2, time works in your favor. With gambling, your odds stay the same no matter how long you play. With investing, the longer you are invested, the higher your chances of a positive return. Myth number 3, recessions are bad for your portfolio. Reality? Yes, recessions do bring volatility. But let's take a closer look. During the past 7 recessions, a basic balanced portfolio returned on average just -1% in actual recession years. And often, the years before and the years after recession deliver strong returns. Also, guess how much time our economy has spent in recession in the last 50 years? Only 15% of the time. Yes, only 15% of the time our economy has been in a recession. The real danger isn't the recession. It's making decisions out of fear. Myth number 4, real estate is a better investment than stocks. Reality, while both are excellent long-term investments, when we look at historical returns, as shown in this chart, stocks have outperformed real estate, even in real estate markets like Toronto or Vancouver. Your principal residence is an exception due to favorable tax treatment. I have recorded a video specifically on this topic. Go check it out. Myth number 5, those retiring soon have a short time horizon. Reality, your retirement date isn't the end of your investment timeline. It's a transition point. Your time horizon is your lifetime. In fact, many of you especially those planning for intergenerational wealth transfer, your time horizon extends into your children's or your grandchildren's lives. Investing should match the length of the time you want your money to work for you, not your next milestone. In summary, we live in the age of headlines and market noise. But successful investing still comes down to three things: facts, discipline, and patience. Thank you for watching. If you found today's video informative, feel free to share it with friends and family. And don't hesitate to reach out if you would like to talk about your portfolio and your financial goals. Before I wrap up, since we are now on YouTube, don't forget to subscribe and hit that bell to get notified whenever we post new content. Until next time, stay grounded and safe investing.